Open a ZERODHA account. Chapter 19. Vega. Hindi Gujarati. 19.1 Volatility Types. The last few chapters have laid a foundation of sorts to help us understand volatility better. We now know what it means, how to calculate the same, and use the volatility information for building trading strategies. It is now time to steer back to the main topic, option Greek, and in particular the fourth option, Greek Vega. Before we start digging deeper into Vega, we have to discuss one important topic, Quentin Tarantino smiley face. I'm a huge fan of Quentin Tarantino and his movies. For people not familiar with Quentin Tarantino, let me tell you, he is one of the most talented directors in Hollywood. He is the man behind super cult flicks such as Pulp Fiction, Kill Bill, Reservoir Dogs, Django Unchained, etc. If you've not watched his movies, I'd suggest you do. You may just love these movies as much as I do. It is a known fact that when Quentin Tarantino directs a movie, he keeps all the production details under wraps until the movie's trailer hits the market. Only after the trailer is out people get to know the name of movie, star cast details, brief storyline, movie location, etc. However, this is not the case with the movie he is directing these days, titled The Hateful Eight, due to be released in December 2015. Somehow everything about The Hateful Eight, the star cast, storyline, location, etc. is leaked. Hence people already know what to expect from Tarantino. Now, given that most of the information about the movie is already known, there are wild speculations about the box office success of his upcoming movie. We could do some analysis on this. Past movies. We know almost all of Tarantino's previous movies were successful. Based on his past directorial performance, we can be reasonably certain that The Hateful Eight is likely to be a box office hit. Movie analysts forecast. There are these professional Hollywood movie analysts who understand the business of cinema very well. Some of these analysts are forecasting that The Hateful Eight may not do well, unlike his previous flicks, as most of the details pertaining to the movie is already failing to enthuse the audience. Social media. If you look at the discussions on The Hateful Eight on social media sites such as Twitter and Facebook, you'd realize that a lot of people are indeed excited about the movie, despite knowing what to expect from the movie. Going by the reactions on social media, The Hateful Eight is likely to be a hit. The actual outcome, irrespective of what really is being expected. Once the movie is released, we would know if the movie is a hit or a flop. Of course, this is the final verdict for which we have to wait till the movie is released. Tracking the eventual fate of the movie is not really our concern. Although I'm certainly going to watch the movie smiley face. Given this, you may be wondering why we are even discussing Quentin Tarantino in a chapter concerning options and volatility. Well, this is just my attempt, hopefully not lame, to explain the different types of volatility that exist: historical volatility, forecasted volatility, and implied volatility. So let's get going. Historical volatility is similar to us judging the box office success of The Hateful Eight based on Tarantino's past directorial ventures. In the stock market world, we take the past closing prices of the stock index and calculate the historical volatility. Do recall, we discussed the technique of calculating the historical volatility in Chapter 16. Historical volatility is very easy to calculate and helps us with most of the day-to-day requirements. For instance, historical volatility can somewhat be used in the options calculator to get a quick and dirty option price. More on this in the subsequent chapters. Forecasted volatility is similar to the movie analyst attempting to forecast the fate of The Hateful Eight. In the stock market world, analysts forecast the volatility. Forecasting the volatility refers to the act of predicting the volatility over the desired time frame. However, why would you need to predict the volatility? Well, there are many option strategies, the profitability of which solely depends on your expectation of volatility. If you have a view of volatility, for example, you expect volatility to increase by 12.34% over the next 7 trading sessions, then you can set up option strategies which can profit this view, provided the view is right. Also, at this stage you should realize, to make money in the stock markets it is not necessary to have a view on the direction on the markets. The view can be on volatility as well. Most of the professional options traders trade based on volatility and not really the market direction. I have to mention this, many traders find forecasting volatility is far more efficient than forecasting market direction. Now clearly having a mathematical, statistical model to predict volatility is much better than arbitrarily declaring, I think the volatility is going to shoot up. There are a few good statistical models such as generalized autoregressive conditional heteroscedasticity (GARCH) process. I know it sounds spooky, but that's what it's called. There are several GARCH processes to forecast volatility. If you are venturing into this arena, I can straight away tell you that GARCH 1.1 or GARCH 1.2 are better suited processes for forecasting volatility. Implied volatility (IV) is like the people's perception on social media. It does not matter what the historical data suggests or what the movie analyst is forecasting about. The Hateful Eight. People seem to be excited about the movie, and that is an indicator of how the movie is likely to fare. Likewise, the implied volatility represents the market participants' expectation on volatility. So on one hand we have the historical and forecasted volatility, both of which are sort of manufactured, while on the other hand we have implied volatility, which is in a sense consensual. Implied volatility can be thought of as consensus volatility arrived amongst all the market participants with respect to the expected amount of underlying price fluctuation over the remaining life of an option. Implied volatility is reflected in the price of the premium. For this reason, amongst the 3 different types of volatility, the IV is usually more valued. You may have heard or noticed India VIX on NSE website. India VIX is the official implied volatility index that one can track. India VIX is computed based on a mathematical formula. Here is a white paper which explains how India VIX is calculated. If you find the computation a bit overwhelming, then here is a quick wrap on what you need to know about India VIX. I have reproduced some of these points from the NSE's white paper. NSE computes India VIX based on the order book of Nifty options. The best bid-ask rates for near-month and next-month Nifty options contracts are used for computation of India VIX. India VIX indicates the investor's perception of the market's volatility in the near term, next 30 calendar days. Higher the India VIX values, higher the expected volatility, and vice versa. When the markets are highly volatile, market tends to move steeply, and during such time the volatility index tends to rise. Volatility index declines when the markets become less volatile. Volatility indices such as India VIX are sometimes also referred to as the fear index, because as the volatility index rises, one should become careful, as the markets can move steeply into any direction. Investors use volatility indices to gauge the market volatility and make their investment decisions. Volatility index is different from a market index like Nifty. Nifty measures the direction of the market and is computed using the price movement of the underlying stocks, whereas India VIX measures the expected volatility and is computed using the order book of the underlying Nifty options. While Nifty is a number, India VIX is denoted as an annualized percentage. Further, NSE publishes the implied volatility for various strike prices for all the options that get traded. You can track these implied volatilities by checking the option chain. For example, here is the option chain of CIPLA, with all the IVs marked out. The implied volatilities can be calculated using a standard options calculator. We will discuss more about calculating IV and using IV for setting up trades in the subsequent chapters. For now, we will now move over to understand Vega. Realized volatility is pretty much similar to the eventual outcome of the movie, which we would get to know only after the movie is released. Likewise, the realized volatility is looking back in time and figuring out the actual volatility that occurred during the expiry series. Realized volatility matters especially if you want to compare today's implied volatility with respect to the historical implied volatility. We will explore this angle in detail when we take up option trading strategies. 19.2 Vega. Have you noticed this? Whenever there are heavy winds and thunderstorms, the electrical voltage in your house starts fluctuating violently. And with the increase in voltage fluctuations, there is a chance of a voltage surge and therefore the electronic equipment at house may get damaged. Similarly, when volatility increases, the stock index price starts swinging heavily. To put this in perspective, imagine a stock is trading at 100 rupees. With increase in volatility, the stock can start moving anywhere between 90 and 110. So when the stock hits 90, all put option writers start sweating as the put options now stand a good chance of expiring in the money. Similarly, when the stock hits 110, all call option writers would start panicking as all the call options now stand a good chance of expiring in the money. Therefore, irrespective of calls or puts, when volatility increases, the option premiums have a higher chance to expire in the money. Now, think about this. Imagine you want to write 500 CE options when the spot is trading at 475 in 10 days to expire. Clearly, there is no intrinsic value, but there is some time value. Hence, assume the option is trading at 20 rupees. Would you mind writing the option? You may write the options and pocket the premium of 20 rupees per, I suppose. However, what if the volatility over the 10-day period is likely to increase? Maybe election results or corporate results are scheduled at the same time. Will you still go ahead and write the option for 20 rupees? Maybe not. As you know, with the increase in volatility, the option can easily expire in the money, hence you may lose all the premium money you have collected. If all option writers start fearing the volatility, then what would compel them to write options? Clearly, a higher premium amount would. Therefore, instead of 20 rupees, if the premium was 30 or 40, you may just think about writing the option, I suppose. In fact, this is exactly what goes on when volatility increases or is expected to increase. Option writers start fearing that they could be caught writing options that can potentially transition to in the money. But nonetheless, fear too can be overcome for a price. Hence, option writers expect higher premiums for writing options. And therefore the premiums of call and put options go up when volatility is expected to increase. The graphs below emphasizes the same point. X-axis represents volatility in percent and Y-axis represents the premium value in rupees, clearly. As we can see, when the volatility increases, the premiums also increase. This holds true for both call and put options. The graphs here go a bit further. It shows you the behavior of option premium with respect to change in volatility and the number of days to expiry. Have a look at the first chart. C. The blue line represents the change in premium with respect to change in volatility when there is 30 days left for expiry. Likewise, the green and red line represents the change in premium with respect to change in volatility when there is 15 days left and 5 days left for expiry respectively. Keeping this in perspective, here are a few observations. Observations are common for both call and put options. Referring to the blue line, when there are 30 days left for expiry, start of the series, and the volatility increases from 15% to 30%. The premium increases from 97 to 190, representing about 95.5% change in premium. Referring to the green line, when there are 15 days left for expiry, mid-series, and the Volatility increases from 15% to 30%. The premium increases from 67 to 100, representing about 50% change in premium. Referring to the red line, when there are 5 days left for expiry, towards the end of series end, the volatility increases from 15% to 30%. The premium increases from 38 to 56, representing about 47% change in premium. Keeping the above observations in perspective, we can make few deductions. The graphs above considers a 100% increase of volatility from 15% to 30% and its effect on the premiums. The idea is to capture and understand the behavior of increase in volatility with respect to premium in time. Please be aware that observations hold true even if the volatility moves by smaller amounts like maybe 20% or 30%. It's just that the respective move in the premium will be proportional. The effective increase in volatility is maximum when there are more days to expiry. This means if you are at the start of series and the volatility is high, then you know premiums are plumb. Maybe a good idea to write these options and collect the premiums. Invariably when volatility cools off, the premiums also cool off and you could pocket the differential in premium. When there are a few days to expiry and the volatility shoots up, the premiums also goes up, but not as much as it would when there are more days left for expiry. So if you are wondering why your long options are not working favorably in a highly volatile environment, make sure you look at the time to expiry. So at this point, one thing is clear: with increase in volatility, the premiums increase. But the question is, by how much? This is exactly what the Vega tells us. The Vega of an option measures the rate of change of options value, premium, with every percentage change in volatility. Since options gain value with increase in volatility, the Vega is a positive number for both calls and puts. For example, if the option has a Vega of 0.15, then for each percent change in volatility, the option will gain or lose 0.15 in its theoretical value. 19.3 Taking things forward. It is now perhaps time to revisit the path this module on option trading has taken and will take. Going forward, over the next few chapters, we started with the basic understanding of the options structure and then proceeded to understand the call and put options from both the buyer and seller's perspective. We then moved forward to understand the moneyness of options and few basic technicalities with respect to options. We further understood option Greeks such as the delta, gamma, theta, and vega, along with a mini-series of normal distribution and volatility. At this stage, our understanding on Greeks is one-dimensional. For example, we know that as in when the market moves, the option premiums move owing to delta. But in reality, there are several factors that work simultaneously. On one hand, we can have the markets moving heavily. At the same time, volatility could be going crazy. Liquidity of the options getting sucked in and out. And all of this while the clock keeps ticking. In fact, this is exactly what happens on an everyday basis in markets. This can be a bit overwhelming for newbie traders. It can be so overwhelming that they quickly rebrand the markets as casino. So the next time you hear someone say such a thing about the markets, make sure you point them to varsity smiley face. Anyway, the point that I wanted to make is that all these Greeks manifest itself on the premiums, and therefore the premiums vary on a second-by-second basis. So it becomes extremely important for the trader to fully understand these inter-Greek interactions of sorts. This is exactly what we will do in the next chapter. We will also have a basic understanding of the Black and Scholes options pricing formula and how to use the same. 19.4 Flavors of Inter-Greek Interactions. The following article was featured in Business Line dated the 31st of August 2015. Here is something that happened very recently. By now everyone remotely connected with the stock market would know that on the 24th of August 2015, the Indian markets declined close to 5.92%, making it one of the worst single-day declines in the history of Indian stock markets. None of the frontline stocks survived the onslaught and they all declined by 8 to 10%. Panic days such as these are a common occurrence in the equity markets. However, something unusual happened in the options markets on the 24th of August 2015. Here are some data points from that day. Nifty declined by 4.92% or about 490 points. India VIX shot up by 64%. But call option premiums shot up. Traders familiar with options would know that the call option premiums decline when market declines. In fact, most of the call option premiums strikes below 8,600 did decline in value, but option strikes above 8,650 behave differently. Their premium, as opposed to the general expectation, did not decline, rather increased by 50 to 80%. This move has perplexed many traders, with many of the traders attributing this move to random theories such as rate rigging, market manipulation, technological inefficiency, liquidity issues, etc. But I suspect any of this is true. In fact, this can be explained based on the option theory logic. We know that option premiums are influenced by sensitivity factors, aka the option Greeks. Delta, as we know, captures the sensitivity of options premium with respect to the movement of the underlying. Here is a quick recap. If the delta of a particular call option is 0.75, then for every 1 point decrease in the underlying, the premium is expected to decrease by 0.75 points. On the 24th of August, Nifty declined by 490 points. So all call options which had noticeable delta, like 0.2, 0.3, 0.6, etc., declined. Typically, in the money options, as on the 24th of August, all strike below 8,600 tend to have noticeable delta. Therefore, all their premiums declined with the decline in the underlying. Out of the money options usually have a very low delta, like 0.1 or lower. This means, irrespective of the move in the underlying, the movement in the option premium will be very restrictive. As on August 24th, all options above 8,600 were out of the money options with low delta values. Hence, irrespective of the massive fall in the market, these call options did not lose much premium value. The above explains why certain call options did not lose value. But why did the premiums go up? The answer to this lies in Vega, the option Greek, which captures the sensitivity of market volatility on options premiums. With increase in volatility, the Vega of an option increases irrespective of calls and puts. And with increase in Vega, the option premium tends to increase. On the 24th of August, the volatility of Indian markets shot up by 64%. This increase in volatility was totally unexpected by the market participants. With the increase in volatility, the Vega of all options increases. Thereby their respective premiums also increased. The effective Vega is particularly high for out-of-the-money options, so on one hand the low delta value of out-of-the-money call options prevented the option premiums from declining, while, on the other hand, high Vega value increased the option premium for these out-of-the-money options. Hence, on the 24th of August 2015, we got to witness the unusual call option premium increasing 50 to 80%. On a day when markets crashed 5.92%. Key takeaways from this chapter. Historical volatility is measured by the closing prices of the stock index. Forecasted volatility is forecasted by volatility forecasting models. Implied volatility represents the market participants' expectation of volatility. India VIX represents the implied volatility over the next 30 days period. Vega measures the rate of change of premium with respect to change in volatility. All options increase in premium when volatility increases. The effective volatility is highest when there are more days left for expiry. Taki cannot access the selected text from this type of page. It is a very Open a ZERODHA account. Chapter 20. Greek Interactions. Hindi Gujarati. 20.1 Volatility Smile. We had briefly looked at inter-Greek interactions in the previous chapter and how they manifest themselves on the options premium. This is an area we need to explore in more detail, as it will help us select the right strikes to trade. However, before we do that, we will touch upon two topics related to volatility called Volatility Smile and Volatility Cone. Volatility Smile is an interesting concept. Something that I consider good to know kind of concept. For this reason, I will just touch upon this and not really dig deeper into it. Theoretically speaking, all options of the same underlying expiring on the same expiry day should display similar implied volatilities IV. However, in reality this does not happen. Have a look at this image. This is the option chain of SBI as of the 4th of September 2015. SBI is trading around 225. Hence the 225 strike becomes at the money option. And the same is highlighted with a blue band. The two green bands highlight the implied volatilities of all the other strikes. Notice this, as you go away from the ATM option, for both calls and puts, the implied volatilities increase. In fact, further you move from ATM, the higher is the IV. You can notice this pattern across all the different stocks, indices. Further, you will also observe that the implied volatility of the ATM option is the lowest. If you plot a graph of all the option strikes versus their respective implied volatility, you will get to see a graph similar to the one below. The graph appears like a pleasing smile. Hence the name Volatility Smile, smiley face. 20.2 Volatility Cone. All the graphs in this chapter and in this section on Volatility Cone has been authored by Prakash Lekala. So far we have not touched upon an option strategy called full call spread. But for the sake of this discussion, I will make an assumption that you are familiar with this strategy. For an options trader, implied volatility of the options greatly affects the profitability. Consider this: you are bullish on stock and want to initiate an option strategy such as a bull call spread. If you initiate the trade when the implied volatility of options is high, then you will have to incur high upfront costs and lower profitability potential. However, if you initiate the position when the option implied volatility is low, your trading position will incur lower costs and higher potential profit. For instance, as of today, Nifty is trading at 7,789. Suppose the current implied volatility of option positions is 20%. Then a 7,800 CE and 8,000 CE bull call spread would cost 72 with a potential profit of 128. However, if the implied volatility is 35% instead of 20%, the same position would cost 82 with potential profit of 118. Notice, with higher volatility, a bull call spread not only costs higher but the profitability greatly reduces. So the point is, for option traders, it becomes extremely crucial to assess a level of volatility in order to time the trade accordingly. Another problem an option trader has to deal with is the selection of the underlying in the strike, particularly true if your strategies are volatility-based. For example, Nifty ATM options currently have an IV of approximately 25%, whereas SBI ATM options have an IV of approximately 52%. Given this, should you choose to trade Nifty options because IV is low, or should you go with SBI options? This is where the volatility cone comes handy. It addresses these sorts of questions for option traders. Volatility cone helps the trader to evaluate the costliness of an option, i.e., identify options which are trading costly, cheap. The good news is, you can do it not only across different strikes of a security but also across different securities as well. Let's figure out how to use the volatility cone. Below is a Nifty chart for the last 15 months. The vertical lines mark the expiry dates of the derivative contracts, and the boxes prior to the vertical lines mark the price movement of Nifty 10 days prior to expiry. If you calculate the Nifty's realized volatility in each of the boxes, you will get the following table. Expiry date annualized realized volatility. June 14.41%. JUL 14.38%. August 14.33%. Sep 14.28%. October 14.28%. November 14.41%. Dec 14.26%. Jan 15.22%. Feb 15.56%. Mar 15.19%. April 15.13%. May 15.34%. June 15.17%. JUL 15.41%. August 15.21%. From the above table we can observe that Nifty's realized volatility has ranged from a maximum of 56% February 2015 to a minimum of 13% April 2015. We can also calculate mean and variance of the realized volatility, as shown below. Particulars details. Maximum volatility 56%. Plus 2 standard deviation SD 54%. Plus 1 standard deviation SD 42%. Mean average volatility 31%. Minus 1 standard deviation SD 19%. Minus 2 standard deviation SD 7%. Minimum volatility 13%. If we repeat this exercise for 10, 20, 30, 45, 60 and 90-day windows, we would get a table as follows. Days to expiry 10, 20, 30, 45, 60, 90. Max 56%, 49%, 41%, 40%, 37%, 35%. Plus 2, SD 54%, 46%, 42%, 41%, 40%, 38%. Plus 1, SD 42%, 38%, 36%, 36%, 35%, 33%. Mean average 30%, 29%, 30%, 30%, 30%, 29%. Minus 1 SD 19%, 21%, 23%, 24%, 24%, 24%. Minus 2 SD 7%, 13%, 17%, 19%, 19%, 19%. Min 13%, 16%, 21%, 22%, 21%, 20%. The graphical representation of the table above would look like a cone as shown below. Hence the name Volatility Cone. The way to read the graph would be to first identify the number of days to expiry and then look at all the data points that are plotted right above it. For example, if the number of days to expiry is 30, then observe the data points representing realized volatility right above it to figure out the minimum. 2 SD, minus 1 SD, average implied volatility, etc. Also, to bear in mind, the volatility cone is a graphical representation on the historical realized volatility. Now that we have built the volatility cone, we can plot the current day's implied volatility on it. The graph below shows the plot of Nifty's near month September 2015 and next month October 2015 implied volatility on the volatility cone. Each dot represents the implied volatility for an option contract, blue or for call options and black for put options. For example, starting from left, look at the first set of dots. There are 3 blue and black dots. Each dot represents an implied volatility of an option contract, so the first blue dot from bottom could be the implied volatility of 7800 CE. Above that it could be the implied volatility of 8000 CE, and above that it could be the implied volatility of 8100 pay, etc. Do note the first set of dots, starting from left, represent near-month options, September 2015, and are plotted at 12 on x-axis, i.e., these options will expire 12 days from today. The next set of dots is for middle month, October 2015, plotted at 43, i.e., These options will expire 43 days from today. Interpretation. Look at the second set of dots from left. We can notice a blue dot above the +2 USD line, topmost line, colored in maroon, for middle month option. Suppose this dot is for option 8200 CE, expiring the 29th of October 2015. Then it means that today 8200 CE is experiencing an implied volatility, which is higher by +2 USD than the volatility experienced in this stock whenever there are 43 days to expiry over the last 15 months. Remember, we have considered data for 15 months. Therefore, this option has a high IV. Hence, the premiums would be high, and one can consider designing a trade to short the volatility, with an expectation that the volatility will cool off. Similarly, a black dot near -2 USD line on the graph is for a put option. It suggests that this particular put option has very low IV, hence low premium, and therefore it could be trading cheap. One can consider designing a trade so as to buy this put option. A trader can plot volatility cone for stocks and overlap it with the option's current IV. In a sense, the volatility cone helps us develop an insight about the state of current implied volatility with respect to the past realized volatility. Those options which are close to +2 USD line are trading costly, and options near -2 USD line are considered to be trading cheap. Trader can design trades to take advantage of mispriced IV. In general, try to short options which are costlier and go long on options which are trading cheap. Please note, use the plot only for options which are liquid. With this discussion on volatility smile and volatility cone, hopefully our understanding on volatility has come to a solid ground. 20.3 Gamma versus time. Over the next two sections, let us focus our attention to inter-Greek interactions. Let us now focus a bit on Greek interactions. And to begin with, we will look into the behavior of gamma with respect to time. Here are a few points that will help refresh your memory on gamma. Gamma measures the rate of change of delta. Gamma is always a positive number for both calls and puts. Large gamma can translate to large gamma risk, directional risk. When you buy options, calls or puts, you are long gamma. When you short options, calls or puts, you are short gamma. Avoid shorting options which have a large gamma. The last point says, avoid shorting options which have a large gamma. Fair enough. However, imagine this, you are at a stage where you plan to short an option which has a small gamma value. The idea being you short the low gamma option and hold the position till expiry so that you get to keep the entire option premium. The question, however, is, how do we ensure the gamma is likely to remain low throughout the life of the trade? The answer to this lies in understanding the behavior of gamma versus time to expiry, maturity. Have a look at the graph below. The graph above shows how the gamma of ITM, ATM, and OTM options behave as the time to expiry starts to reduce. The y-axis represents gamma and the x-axis represents time to expiry. However, unlike other graphs, don't look at the x-axis from left to right. Instead, look at the x-axis from right to left. At extreme right, the value reads 1, which suggests that there is ample time to expiry. The value at the left end reads 0, meaning there is no time to expiry. The time lapse between 1 and 0 can be thought of as any time period: 30 days to expiry, 60 days to expiry, or 365 days to expiry. Irrespective of the time to expiry, the behavior of gamma remains the same. The graph above drives across these points. When there is ample time to expiry, all three options ITM, ATM, OTM have low gamma values. ITM options gamma tends to be lower compared to ATM or OTM options. The gamma values for all three strikes, ATM, OTM, ITM, remain fairly constant till they are halfway through the expiry. ITM and OTM options race towards 0 gamma as we approach expiry. The gamma value of ATM options shoot up drastically as we approach expiry. From these points it is quite clear that you really do not want to be shorting ATM options, especially close to expiry, as ATM gamma tends to be very high. In fact, if you realize we are simultaneously talking about three variables here: gamma, time to expiry, and option strike. Hence, visualizing the change in one variable with respect to change in another makes sense. Have a look at the image below. The graph above is called a surface plot. This is quite useful to observe the behavior of three or more variables. The x-axis contains time to expiry, and the y-axis contains the gamma value. There is another axis which contains strike. There are a few red arrows plotted on the surface plot. These arrows are placed to indicate that each line that the arrow is pointing to refers to different strikes. The outermost line on either side indicates OTM and ITM strikes, and the line at the center corresponds to ATM option. From these lines it is very clear that, as we approach expiry, the gamma values of all strikes except ATM tends to move towards zero. The ATM and few strikes around ATM have non-zero gamma values. In fact, gamma is highest for the line at the center, which represents ATM option. We can look at it from the perspective of the strike price. This is the same graph but shown from a different angle, keeping the strike in perspective. As we can see, the gamma of ATM options shoot up while the gamma of other option strikes don't. In fact, here is a 3D rendering of gamma versus strike versus time to expiry. The graph below is a GIF. In case it refuses to render properly, please do click on it to see it in action. Hopefully the animated version of this surface plot gives $20.4 delta versus implied volatility. These are interesting times for options traders. Have a look at the image below. The snapshot was taken on the 11th of September when Nifty was trading at 7,794. The snapshot is that of 6,800 pay, which is currently trading at 8 rupees and 30 paise per. Figure this. 6,800 is a good 1,100 points away from the current Nifty level of 7,794. The fact that 6,800 pay is trading at 5.5 implies there are a bunch of traders who expect the market to move 1,100 points lower within 11 trading sessions. Do note there are also 2 trading holidays from now to expiry. Given the odds of Nifty moving 1,114% lower from present level in 11 trading sessions are low, why is the 6,800 pay trading at 8.3? Is there something else driving the options prices higher besides pure expectations? Well, the following graph may just have the answer for you. The graph represents the movement of delta with respect to strike price. Here is what you need to know about the graph above. The blue line represents the delta of a call option when the implied volatility is 20%. The red line represents the delta of a call option when the implied volatility is 40%. The green line represents the delta of a put option when the implied volatility is 20%. The purple line represents the delta of a put option when the implied volatility is 40%. The call option delta varies from 0 to 1. The put option delta varies from 0 to -1. Assume the current stock price is 175. Hence 175 becomes ATM option. With the above points in mind, let us now understand how these deltas behave. Starting from left, observe the blue line, CE delta when IV is 20%. Considering 175 is the ATM option, strikes such as 135, 145, etc. are all deep ITM. Clearly, deep ITM options have a delta of 1. When IV is low, 20%, the delta gets flattened at the ends, deep OTM and ITM options. This implies that the rate at which delta moves, further implying the rate at which the option premium moves, is low. In other words, deep ITM options tends to behave exactly like a futures contract when volatility is low, and OTM option prices will be close to zero. You can observe similar behavior for put option with low volatility. Observe the green line. Look at the red line, delta of CE when volatility is 40%. We can notice that the end ITM, OTM is not flattened. In fact, the line appears to be more reactive to underlying price movement. In other words, the rate at which the options premium change with respect to change in underlying is high when volatility is high. In other words, a large range of options around ATM are sensitive to spot price changes when volatility is high. Similar observation can be made for the put options when volatility is high, purple line. Interestingly, when the volatility is low, look at the blue and green line, the delta of OTM options goes to almost zero. However, when the volatility is high, the delta of OTM never really goes to zero and it maintains a small non-zero value. Now, going back to the initial thought, why is the 6,800 pay, which is 1100 points away, trading at 8 rupees and 30 paise per? Well, that's because 6,800 pay is a deep OTM option. And as the delta graph above suggests, when the volatility is high, see image below, deep OTM options have non-zero delta value. I would suggest you draw your attention to the delta versus IV graph and in particular look at the call option delta when implied volatility is high, maroon line. As we can see, the delta does not really collapse to zero like the blue line, CE delta when IV is low. This should explain why the premium is not really low. Further add to this the fact that there is sufficient time value. The OTM option tends to have a respectable premium. Download the Volatility Cone XL. Key takeaways from this chapter. Volatility Smile helps you visualize the fact that the OTM options usually have high IVs. With the help of a Volatility Cone, you can visualize today's implied volatility with respect to past realized volatility. Gamma is high for ATM option, especially towards the end of expiry. Gamma for ITM and OTM options goes to zero when we approach expiry. Delta has an effect on lower range of options around ATM when IV is low and its influence increases when volatility is high. When the volatility is high, the far OTM options do tend to have a non-zero delta value. Open a ZERODHA account. Chapter 21. Greek Calculator. Hindi Gujarati. 21.1 Background. So far in this module we have discussed all the important option Greeks and their applications. It is now time to understand how to calculate these Greeks using the Black and Scholes (BS) options. Pricing Calculator. The BS options pricing calculator is based on the Black and Scholes options pricing model, which was first published by Fisher Black and Myron Scholes, hence the name Black and Scholes, in 1973. However, Robert C. Merton developed the model and brought in a full mathematical understanding to the pricing formula. This particular pricing model is highly revered in the financial market. So much so that both Robert C. Merton and Myron Scholes received the 1997 Nobel Prize for Economic Sciences. The B&S options pricing model involves mathematical concepts such as partial differential equations, normal distribution, stochastic processes, etc. The objective in this module is not to take you through the math in B&S model. In fact, you could look at this video from Khan Academy for the same. My objective is to take you through the practical application of the Black and Scholes options pricing formula. 21.2 Overview of the model. Think of the BS calculator as a black box, which takes in a bunch of inputs and gives out a bunch of outputs. The inputs required are mostly market data of the options contract, and the outputs are the option Greeks. The framework for the pricing model works like this. We input the model with spot price, strike price, interest rate, implied volatility, dividend, and number of days to expiry. The pricing model churns out the required mathematical calculation and gives out a bunch of outputs. The output includes all the option Greeks and the theoretical price of the call and put option for the strike selected. The illustration below gives the schema of a typical options calculator. On the input side, spot price. This is the spot price at which the underlying is trading. Note we can even replace the spot price with the futures price. We use the futures price when the option contract is based on futures as its underlying. Usually the commodity and in some cases the currency options are based on futures. For equity option contracts, always use the spot price. Interest rate. This is risk-free rate prevailing in the economy. Use the RBI 91-day Treasury bill rate for this purpose. You can get the rate from the RBI website. RBI has made it available on their landing page, as highlighted below. As of September 2015, the prevailing rate is 7.4769% per annum. Dividend. This is the dividend per share expected in the stock, provided the stock goes ex-dividend within the expiry period. For example, assume today is the 11th of September and you wish to calculate the option Greeks for the CC Bank option contract. Assume a CC Bank is going ex-dividend on the 18th of September with a dividend of 4 rupees. The expiry for the September series is the 24th of September 2015. Hence the dividend would be 4 rupees. In this case, number of days to expiry. This the number of calendar days left to expiry. Volatility. This is where you need to enter the option's implied volatility. You can always look at the option chain provided by NSE to extract the implied volatility data. For example, here is the snapshot of a CC Bank's 280 CE. And as we can see, the IV for this contract is 43.55%. Let us use this information to calculate the option Greeks for a CC 280 CE. Spot price equals 272.7. Interest rate equals 7.4769%. Dividend equals 0. Number of days to expiry equals 1. Today is the 23rd of September, and expiry is on the 24th of September. Volatility equals 43.55%. Once we have this information, we need to feed this into a standard Black and Scholes options calculator. We do have this calculator on our website, https://zeroda.com/tools/black-scholes. You can use the same to calculate the Greeks. Once you enter the relevant data in the calculator and click on Calculate, the calculator displays the option Greeks. On the output side, notice the following. The premium of 280 CE and 280 pay is calculated. This is the theoretical option prices per the B&S options calculator. Ideally, this should match with the current option price in the market. Below the premium values, all the options Greeks are listed. I'm assuming that by now you are fairly familiar with what each of the Greeks convey, and the application of the same. One last note on option calculators. The option calculator is mainly used to calculate the option Greeks and the theoretical option price. Sometimes small difference arises owing to variations in input assumptions. Hence, for this reason, it is good to have room for the inevitable modeling errors. However, by and large, the option calculator is fairly accurate. 21.3 Put Call Parity. While we are discussing the topic on option pricing, it perhaps makes sense to discuss Put Call Parity Pcp. Pcp is a simple mathematical equation which states put value plus spot price equals present value of strike invested to maturity plus call value. The equation above holds true assuming both the put and call are ATM options. The options are European. They both expire at the same time. The options are held till expiry. For people who are not familiar with the concept of present value, I would suggest you read through this http://zerodha.com/varsity/chapter/dcf-primer/section 14.3. Assuming you are familiar with the concept of present value, we can restate the above equation as P plus S equals KERT plus C, where KERT represents the present value of strike, with K being the strike itself. In mathematical terms, strike K is getting discounted continuously at rate of R over time. Also, do realize if you hold the present value of the strike and hold the same to maturity, you will get the value of strike itself. Hence the above can be further restated as put option plus spot price equals strike plus call options. So why should the equality hold? To help you understand this better, think about two traders, Trader A and Trader B. Trader A holds ATM put option and 1 share of the underlying stock, left-hand side of PCP equation. Trader B holds a call option and cash amount equivalent to the strike, right-hand side of PCP equation. This being the case, as per the PCP, the amount of money both traders make, assuming they hold till expiry, should be the same. Let us put some numbers to evaluate the equation. Underlying equals Infosys. Strike equals 1200. Spot equals 1200. Trader A holds equals 1200 pay plus 1 share of Infi at 1200. Trader B holds equals 1200 CE plus cash equivalent to strike, i.e. 1200. Assume upon expiry Infosys expires at 1100. What do you think happens? Trader A's put option becomes profitable and he makes 100 rupees, however he loses 100 on the stock that he holds. Hence his net payoff is 100 plus 1100 equals 1200. Trader B's call option becomes worthless. Hence the option's value goes to 0. However, he has cash equivalent to 1200. Hence his account value is 0 plus 1200 equals 1200. Let's take another example. Assume Infi hits 1350 upon expiry. Let's see what happens to the accounts of both the traders. Trader A equals put goes to 0. Stock goes to 1350. Trader B equals call value goes to 150 plus 1200 in cash equals 1350. So clearly, irrespective of where the stock expires, the equations hold true, meaning both Trader A and Trader B end up making the same amount of money. All good. But how would you use the PCP to develop a trading strategy? Well, for that, you will have to wait for the next module, which is dedicated to option strategies, J. Before we start the next module on option strategies, we have 2 more chapters to go in this module. Key takeaways from this chapter. The options calculator is based on the Black and Scholes model. The Black and Scholes model is used to estimate the options theoretical price along with the options Greek. The interest rate in the B&S calculator refers to the risk-free rate as available on the RBI site. The implied volatility can be fetched from the option chain from the NSE website. The put call parity states that the payoff from a put option plus the spot equals the payoff from call option plus the strike. 111 Open a ZERODHA account. Chapter 22. Reintroducing call and put options. Hindi Gujarati. 22.1 Why now? I suppose this chapter's title may confuse you. After rigorously going through the options concept over the last 21 chapters, Why are we now going back to call and put options again? In fact, we started the module by discussing the call and put options. So why all over again? Well, this is because I personally believe that there are two learning levels in options: before discovering option Greeks and after discovering the option Greeks. Now that we have spent time learning option Greeks, perhaps it is time to take a fresh look at the basics of the call and put options. Keeping the option Greeks in perspective, let's have a quick high-level recap. You buy a call option when you expect the underlying price to increase. You are outrightly bullish. You sell a call option when you expect the underlying price not to increase. You expect the market to either stay flat or go down, but certainly not up. You buy a put option when you expect the underlying price to decrease. You are outrightly bearish. You sell a put option when you expect the underlying price not to decrease. You expect the market to stay flat or go up, but certainly not down. Of course, the initial few chapters gave us an understanding on the call and put option basics. But the agenda now is to understand the basics of call and put options, keeping both volatility and time in perspective. So let's get started. 22.2 Effective Volatility. We know that one needs to buy a call option when she expects the underlying asset to move higher. Fair enough. For a moment, let us assume that Nifty is expected to go up by a certain percent. Given this, would you buy a call option if the volatility is expected to go down while Nifty is expected to go up? What would you do if the time to expiry is just 2 days away? What would you do if the time to expiry is more than 15 days away? Which strike would you choose to trade in the above two cases, OTM, ATM, or ITM, and why would you choose the same? These questions clearly demonstrate the fact that buying a call option or put option is not really a straightforward task. There is a certain degree of groundwork required before you buy an option. The groundwork mainly revolves around assessment of volatility, time to expiry, and of course the directional movement of the market itself. I will not talk about the assessment of market direction here. This is something you will have to figure out yourself based on theories such as technical analysis, quantitative analysis, or any other technique that you deem suitable. For instance, you could use technical analysis to identify that Nifty is likely to move up by 2 to 3% over the next few days. Having established this, what would you do? Would you buy an ATM option or ITM option? Given the fact that Nifty will move up by 2 to 3% over the next 2 days, which strike gives you maximum bang for the buck? This is the angle I would like to discuss in this chapter. Let's start by looking at the following graph. If you recollect, we discussed this in the chapter on Vega. The graph above depicts how a call option premium behaves with respect to increase in volatility across different time to expiry time frames. For example, the blue line shows how the call option premium behaves when there are 30 days to expiry, green for 15 days to expiry, and red for 5 days to expiry. With help of the graph above, we can arrive at a few practical conclusions which we can incorporate while buying, selling call options. Regardless of time to expiry, the premium always increases with increase in volatility and the premium decreases with decrease in volatility. For volatility to work in favor of a long call option, one should time buying a call option when volatility is expected to increase and avoid buying call option when volatility is expected to decrease. For volatility to work in favor of a short call option, one should time selling a call option when volatility is expected to fall and avoid selling a call option when the volatility is expected to increase. Here is the graph of the put option premium versus volatility. This graph is very similar to the graph of call premium versus volatility, therefore the same set of conclusions hold true for put options as well. These conclusions make one thing clear: buy options when you expect volatility to increase and short options when you expect the volatility to decrease. Now the next obvious question is, which strike to choose when you decide to buy or sell options? This is where the assessment of time to expiry comes into play. 22.3 Effective time. Let us just assume that the volatility is expected to increase along with increase in the underlying prices. Clearly, buying a call option makes sense. However, the more important aspect is to identify the right strike to buy. In fact, when you wish to buy an option, it is important to analyze how far away we are with respect to market expiry. Selection of strike depends on the time to expiry. Do note, understanding the chart below may seem a bit confusing in the beginning, but it is not. So don't get disheartened if you don't get it the first time you read. Just give it another shot. Before we proceed, we need to get a grip on the timelines first. A typical F&O series has about 30 days before expiry, barring February series. To help you understand better, I have divided the series into two halves. The first half refers to the first 15 days of the series, and the second half refers to the last 15 days of the F&O series. Please do keep this in perspective while reading through below. Have a look at the image below. It contains 4 bars charts representing the profitability of different strikes. The chart assumes the stock is at 5,000 in the spot market. Hence, strike 5,000 is ATM. The trade is executed at some point in the first half of the series, i.e. between the start of the F&O series and 15th of the month. We expect the stock to move 4%, i.e. from 5,000 to 5,200. Given the above, the chart tries to investigate which strike would be the most profitable given the target of 4% is achieved within 5 days of trade initiation, 15 days of trade initiation, 25 days of trade initiation, on expiry day. So let us start from the first chart on the left top. This chart shows the profitability of different call option strikes given that the trade is executed in the first half of the F&O series. The target is expected to be achieved within 5 days of trade execution. Here is a classic example. Today is the 7th of October. Infosys results are on the 12th of October, and you are bullish on the results. You want to buy a call option with an intention of squaring it off 5 days from now. Which strike would you choose? From the chart it is clear, when there is ample time to expiry, remember we are at some point in the first half of the series, and the stock moves in the expected direction, then all strikes tend to make money. However, the strikes that make maximum money are FAR OTM options. As we can notice from the chart, maximum money is made by 5,400 and 5,500 strike. Conclusion: when we are in the first half of the expiry series, and you expect the target to be achieved quickly, say over a few days, buy OTM options. In fact, I would suggest you buy 2 or 3 strikes away from ATM and not beyond that. Look at the second chart, top right. Here the assumption is that the trade is executed in the first half the series. The stock is expected to move by 4%, but the target is expected to be achieved in 15 days. Except for the time frame target to be achieved, everything else remains the same. Notice how the profitability changes. Clearly, buying FAR OTM option does not make sense. In fact, you may even lose money when you buy these OTM options. Look at the profitability of 5,500 strike. Conclusion: when we in the first half of the expiry series, and you expect the target to be achieved over 15 days, it makes sense to buy ATM or slightly OTM options. I would not recommend buying options that are more than 1 strike away from ATM. One should certainly avoid buying FAR OTM options. In the third chart, bottom left, the trade is executed in the first half the series and target expectation, 4% move, remains the same, but the target time frame is different. Here the target is expected to be achieved 25 days from the time of trade execution. Clearly, as we can see, OTM options are not worth buying. In most of the cases, one ends up losing money with OTM options. Instead, what makes sense is buying ITM options. Also, at this stage one have to mention this: people end up buying OTM options simply because the premiums are lower. Do not fall for this. The low premium of OTM options creates an illusion that you won't lose much. But in reality there is a very high probability for you to lose all the money, albeit small amounts. This is especially true in cases where the market moves but not at the right speed. For example, the market may move 4%, but if this move is spread across 15 days, then it does not make sense holding FAR OTM options. However, FAR OTM options make money when the movement in the market is swift, for example a 4% move within 1 or say 2 days. This is when FAR OTM options move smartly. Conclusion: when we are at the start of the expiry series, and you expect the target to be achieved over 25 days, it makes sense to buy ITM options. One should certainly avoid buying ATM or OTM options. The last chart bottom right is quite similar to the third chart, except that you expect the target to be achieved on the day of the expiry or very close to expiry. The conclusion is simple: under such a scenario all option strikes, except ITM, lose money. Traders should avoid buying ATM or OTM options. Let us look at another set of charts. The idea here is to figure out which strikes to choose given that the trade is executed in the second half of the series, i.e. at any point from 15th of the month till the expiry. Do bear in mind the effective time decay accelerates in this period. Hence, as we are moving closer to expiry, the dynamic of options change. The 4 charts below help us identify the right strike for different time frames during which the target is achieved. Of course, we do this while keeping theta in perspective. Chart 1, top left, evaluates the profitability of different strikes wherein the trade is executed in the second half of the series and the target is achieved the same day of trade initiation. News-driven option trades such as buying an option owing to a corporate announcement is a classic example. Buying an index option based on the monetary policy decision by RBI is another example. Clearly, as we can see from the chart, all strikes tend to make money when the target is achieved the same day. However, the maximum impact would be on FAR OTM options. Do recall the discussion we had earlier: when market moves swiftly, like 4% in one day, the best strikes to trade are always FAR OTM. Conclusion: when you expect the target to be achieved the same day, irrespective of time to expiry, buy FAR OTM options. I would suggest you buy 2 or 3 strikes away from ATM options and not beyond that. There is no point buying ITM or ATM options. Chart 2, top right, evaluates the profitability of different strikes wherein the trade is executed in the second half of the series and the target is achieved within 5 days of trade initiation. Notice how the profitability of FAR OTM options diminishes. In the above case, chart 1, the target is expected to be achieved in 1 day, therefore buying FAR OTM options made sense. But here the target is achieved in 5 days. And because the trade is kept open for 5 days, especially during the second half of the series, the impact of theta is higher. Hence, it just does not make sense risking with FAR OTM options. The safest bet under such a scenario is strikes which are slightly OTM. Conclusion: when you are in the second half of the series, and you expect the target to be achieved around 5 days from the time of trade execution by strikes that are slightly OTM, I would suggest you buy 1 strike away from ATM options and not beyond that. Chart 3, bottom right, and Chart 4, bottom left, both these charts are similar except in Chart 3, the target is achieved 10 days from the trade initiation, and in Chart 4, the target is expected to be achieved on the day of the expiry. I suppose the difference in terms of number of days won't be much. Hence I would treat them to be quite similar. From both these charts we can reach one conclusion: FAR OTM options tend to lose money when the target is expected to be achieved close to expiry. In fact, when the target is achieved closer to the expiry, the heavier the FAR OTM options bleed. The only strikes that make money are ATM or slightly ITM option. While the discussions we have had so far are with respect to buying a call option, similar observations can be made for put options as well. Here are 2 charts that help us understand which strikes to buy under various situations. These charts help us understand which strikes to trade when the trade is initiated in the first half of the series, and the target is achieved under different time frames. While these charts help us understand which strikes to trade when the trade is executed in the second half of the series and the target is achieved under different time frames. If you go through the charts carefully, you'll realize that the conclusions for the call options holds true for the put options as well. Given this, we can generalize the best practices for buying options. Position initiation target expectation best strike to trade. First half of the series 5 days from initiation far OTM 2 strikes away from ATM. First half of the series 15 days from initiation ATM or slightly OTM 1 strike away from ATM. First half of the series 25 days from initiation slightly ITM options. First half of the series on expiry day ITM. Second half of the series same day far OTM 2 or 3 strikes away from ATM. Second half of the series 5 days from initiation slightly OTM 1 strike away from ATM. Second half of the series 10 days from initiation slightly ITM or ATM. Second half of the series on expiry day ITM. So the next time you intend to buy a naked call or put option, make sure you map the period, either first half or second half of the series, and the time frame during which the target is expected to be achieved. Once you do this, with the help of the table above, you will know which strikes to trade, and more importantly, you will know which strikes to avoid buying. With this, we are now at the verge of completion of this module. In the next chapter, one would like to discuss some of the simple trades that I initiated over the last few days and also share my trade rationale behind each trade. Hopefully the case studies that I will present in the next chapter will give you a perspective on the general thought process behind simple option trades. Key takeaways from this chapter. Volatility plays a crucial role in your decision to buy options. In general, buy options when you expect the volatility to go higher. Sell options when you expect the volatility to decrease. Besides volatility, the time to expiry and the time frame during which the target is expected to be achieved also matters. 87 responses to reintroducing call and put options. Open a ZERODHA account. Chapter 23. Case Studies, wrapping it all up. Hindi Gujarati. 23.1 Case Studies. We are now at the very end of this module, and I hope the module has given you a fair idea on understanding options. I've mentioned this earlier in the module. At this point I feel compelled to reiterate the same. Options, unlike futures, is not a straightforward instrument to understand. Options are multi-dimensional instruments primarily because it has many market forces acting on it simultaneously. And this makes options a very difficult instrument to deal with. From my experience, I've realized the only way to understand options is by regularly trading them, based on options theory logic. To help you get started, I would like to discuss few simple option trades executed successfully. Now here is the best part. These trades are executed by Zero to Varsity readers over the last 2 months. I believe these are trades inspired by reading through the contents of Zero to Varsity. Or at least this is what I was told, slightly smiling face. Either ways, I'm happy because each of these trades has a logic backed by a multidisciplinary approach. So in that sense it is very gratifying. And it certainly makes a perfect end to this module on options theory. Do note the traders were kind enough to oblige to my request to discuss their trades here. However, upon their request I will refrain from identifying them. Here are the 4 trades that I will discuss. CEAT India, directional trade, inspired by technical analysis logic. Nifty, delta neutral, leveraging the effect of Vega. Infosys, delta neutral, leveraging the effect of Vega. Infosys, directional trade, common sense fundamental approach. For each trade I will discuss what I like about it and what could have been better. Denote: all the snapshots presented here are taken by the traders themselves. I just specified the format in which I'd need these snapshots. So, let's get started. 23.2 CEAT India. The trade was executed by a 27-year-old options newbie. Apparently this was his first options trade ever. Here is his logic for the trade. CEAT Limited was trading around 1,260 rupees per share. Clearly, the stock has been in a good uptrend. However, he believed the rally would not continue as there was some sort of exhaustion in the rally. My thinking is that he was encouraged to believe so by looking at the last few candles. Clearly, the last 3 days' trading range was diminishing. To put thoughts into action, he bought the 1220 OTM put options by paying a premium of 45 rupees and 75 paise per lot. The trade was executed on the 28th of September and expiry for the contract was on October 29th. Here is the snapshot of the same. I asked the trader few questions to understand this better. Why did you choose to trade options and not short futures? Shorting futures would be risky, especially in this case, as reversals could be sharp and MTM in case of sharp reversals would be painful when there is so much time to expiry. Why did I choose to trade a slightly OTM option and not really far OTM option? This is because of liquidity. Stock options are not really liquid. Hence sticking to strikes around ATM is a good idea. What about stop loss? The plan is to square off the trade if CEAT makes a new high. In other words, a new high on CEAT indicates that the uptrend is still intact. And therefore my contrarian short call was flawed. What about target? Since the stock is in a good uptrend, the idea is to book profits as soon as it's deemed suitable. Reversals can be sharp, so no point holding on to short trades. In fact, it would not be a bad idea to reverse the trade and buy a call option. What about holding period? The trade is a play on appreciation in premium value, so I will certainly not look at holding this to expiry, given that there is ample time to expiry. A small dip in stock price will lead to a decent appreciation in premium. Note, the Q&A is reproduced in my own words. The idea here is to produce the gist and not the exact word-to-word conversation. So after he bought CEAT Pay, this is what happened the very next day. Stock price declined to $12.44, and the premium appreciated to $52. He was right when he said, since there is ample time to expiry, a small dip in the stock price will lead to a good increase in option premium. He was happy with 7 in profits per lot, and hence he decided to close the trade. Looking back, I guess this was probably a good move. Anyway, I guess this is not bad for a first time overnight options trade. My thoughts on this trade. Firstly, I'd need to appreciate this trader's clarity of thought, more so considering this was his first options trade. If I were to set up a trade on this, I would have done this slightly differently. From the chart perspective, the thought process was clear: exhaustion in the rally. Given this belief, I would prefer selling call options instead of buying them. Why would I do this? Well, exhaustion does not necessarily translate to correction in stock prices. More often than not, the stock would enter a sideways movement, making it attractive to option sellers. I would select strikes based on the normal distribution calculation as explained earlier in this module. Needless to say, one had to keep liquidity in perspective as well. I would have executed the trade, selling calls, in the second half of the series to benefit from time decay. Personally, I do not prefer naked directional trades as they do not give me a visibility on risk and reward. However, the only time when I initiate a naked long call option based on technical analysis trade is when I observe a flag formation. Stock should have rallied prior trend at least 5 to 10%. Should have started correcting 3% or so on low volumes, indicates profit booking by weak hands. I find this a good setup to buy call options. 23.3 RBI News Play Nifty Options. This is a trade in Nifty Index options based on RBI's monetary policy announcement. The trade was executed by a varsity reader from Delhi. I consider this trade structured and well designed. Here is the background for this trade. Reserve Bank of India (RBI) was expected to announce their monetary policy on the 29th of September. While it is hard for anyone to guess what kind of decision RBI would take, the general expectation in the market was that RBI would slash the repo rates by 25 basis points. For people not familiar with monetary policy and repo rates, I would suggest you read this. http://0.com/varsity/chapter/key-events-and-their-impact-on-market/. RBI's monetary policy is one of the most eagerly awaited events by the market participants as it tends to have a major impact on market's direction. Here are few empirical market observations this trader has noted in the backdrop market events. The market does not really move in any particular direction, especially 2 to 3 days prior to the announcement. He finds this applicable to stocks as well. Quarterly results. Before the event announcement, market's volatility invariably shoots up. Because the volatility shoots up, the option premiums for both CE and Pay also shoot up. While I cannot vouch for his first observations, the second and third observation does make sense. So in the backdrop of RBI's policy announcement, ample time value, and increased volatility, see image below, he decided to write options on 28th of September. Nifty was somewhere around 7,780. Hence the strike 7,800 was the ATM option. The 7,800 CE was trading at 203 and the 7,800 pay was trading at 176. Both of which he wrote and collected a combined premium of 379 rupees per. Here is the option chain showing the option prices. I had a discussion with him to understand his plan of action. I'm reproducing the same, in my own words, for your understanding. Had a discussion with him to understand his plan of action. I'm reproducing the same, in my own words, for your understanding. Why are you shorting 7,800 CE and 7,800 pay? Since there was